Robert had a coaching session with Ernie earlier this week, and he also had some follow-up questions via email related to diagonal calendar spreads, the poor man's covered call. And I currently don't have calendar calls up on my available topics, so let's go to the Other Strategies tab. And for the moment, let's remove short callers from my current list, and I'm going to select calendar call from our available strategies. Now, last week, I might detract from this in a moment. Last week, we did have a good discussion for one of our let's go to the main home tab here. Let's go to webinars. But last week we discussed good candidates for the poor man's covered call. And we talked about the criteria we would use, some of the important criteria in line of the delta ratio when opening a new diagonal spread, the time frames we might consider looking for, and of course the importance of the debit to strike difference ratio, meaning that the net debit I pay is always less than the difference in strike prices on my diagonal. So if early assignment occurs, I don't get locked into a loss on the position. Bob had some questions about taking a look at a poor man's covered call on SPY. And there are some subtle differences to that approach, to what we describe we would look for with our default criteria. Now, I do want to be far out in time. I probably want a high delta of maybe 0.7 or 0.8 on the option that I'm buying farther out in time. And I want that delta ratio to be around 1.8. And I also want this debit to strike difference ratio to be less than 1. And what that means is that the debit that I'm paying into the position, in this case 1406, has to be less than my difference in strike prices for this Valero position that came up. Now, let's just take a quick look at the profit and loss chart. And, oh, I'm sorry, there's the stock chart coming back up off the bottom line, and it's might not be the best candidate for a calendar spread actually now that I look at the chart, but let's just take a look at the profit and loss chart for Valero. All right, so this is typically what I want to see with a profit and loss chart on a diagonal spread position. Whether I go further out in time, I stay closer in. When I'm mimicking the covered call, quote unquote, the poor man's covered call, looking for that long option with a delta of maybe 0.8 to mimic stock ownership, but I still want to be slightly out of the money and getting a good premium to allow the stock to grow. If you get into a position where that net debit is actually greater than the difference in strike prices, in this case it's 15, what you probably tend to see is a steep peak and then it pulls back down and you end up with an upper and a lower break even, similar to what you would see with the horizontal spread. Also a calendar spread, but the same strike. Some just call it a straight calendar spread. I call it a horizontal. Anything that to me is a calendar where one's further out and shorter in, and then horizontal, same strike. Diagonal is different strikes as well. That's more of a neutral strategy. If I'm neutral to bullish and planning on mimicking stock ownership and selling a call against it month by month by month by month over the course of the year, I want something similar to what we're seeing here. I don't want that upper and lower break even. I still want to have a profit here. Now, unlike the covered call, of course, which has a static max profit no matter where the stock goes. In the diagonal, you can give some profit back. Why does that happen? Well, it happens because this far out option, starting off with a delta of 0.8, that's a terrible little 8 there, with a delta of 0.8, as the stock continues to move up, this delta is gaining, but it's not going to go to 1. It's going to go to 0.83, 0.87, 0.89, 0.92. But on that short-term expiration, whether it's 1 week out, 2 weeks out, or 3 weeks out, this 100 strike is going to a delta of 0 or a delta of 1. So at expiration, if the stock's here at 105, this went to an automatic delta of 1 that has 5 points of intrinsic value, and this one is still lagging. It might only be at a delta of 0.87, 0.83. It hasn't caught up yet, and it won't go to a delta of 1 until maybe we get up to 140, 150, way deep in the money. Okay, so that's why you see that tail off there at the end. You've gotten the time decay of your short premium, but this delta magically goes to 1 if it's in the money. Your long is still lagging. That's why you see the fall off from that max premium, which you don't see in a covered call position. In that other presentation, I'm not going to spend too much time on it, but in that other presentation, we talked about maybe looking for a delta of 0.7 or 0.8 on the long, a delta ratio, the delta of the long divided by the delta of the short, to be at least maybe 1.8 or 1.6 or higher, really about 1.8. And what does that mean? It means that if this is at 0.8, my short option delta can't be any more than, let's say, 0.41 or 0.42. Okay, if it's at 0.5, if it's right at the money, that doesn't give me the delta ratio I want and won't give me the extra benefit if I am bullish on the position. And we already talked about the debit to strike difference ratio. Where am I going with all this? Robert's questions were, well, if I fear that when I'm rolling the position as the stock moves up, so let's say Valero moved up to 103, I had to buy this back for $3, then I sold the 105 or the 107.5, and then it moved up again and I sold again. His concern was, am I missing, do I have to check the delta ratio each time? And the rough answer is yes. I still want to make sure that I have a good delta ratio. I still want to make sure that the debit, the total I'm paying into this position, that long option plus whatever addition or subtraction I'm getting for the premiums, that total cost into the position is less than the difference in strike prices. Most likely, if the stock's moving up in that nature we talked about gradually, all of that's going to be met without you checking it. Doesn't hurt to check, but all of that's probably going to be met. Where it might change is if the stock ramped up to 110, I paid $10.50 to buy this call back, and I go to the 115 and I'm only getting $2. Well, in essence, minus the premium I already received, but we already accounted that, now my debit's going up to 22. But I'm at 115, aren't I? So my new strike difference is 33. We added $8 and so to our 1406 debit to buy to close at 10.50, sell to open the new one at 2, added $8.50 into the position, but now I'm at the 115 that's slightly out of the money, so I'm 30 points up. This intrinsic gain is going to cover that point as well, okay? So that is important. Is the delta ratio at this point really important? No, because remember, this might have gone up to 0.9, and I can sell the 120, or maybe the 125 if there's a good enough premium. Now I'm not so worried about that delta ratio. I am worried about the debit to strike difference, but I'm not worried about the delta ratio so much because what I'm focusing on, if I am writing for the next cycle, is where do I think the stock's going to be trading next? An example I gave to Robert, I forget the stock we were looking at, but if this was the example, and Valero did run up to 115, very unlikely, but let's say it did run up to 115. If I expected that continue, and I expected the stock to maybe reach 125 by January, and the 120 strike is only offering me, let's say, $2, which is a pretty good premium with a stock at 115, and the 125 is only offering me 70 cents. But if this is where I think the stock's going to go, why would I sell the 120? Because if I'm right, and in January it's trading at 125, I've got to pay back 5, so I'm adding another $3 cost basis. I'd rather just sell the 125, stock ends around 124.90, I keep the full 70-cent position, 70 cents of premium I generated. And this is more of a key that I feel maybe I didn't describe in last week's discussion that I want to talk about here. The criteria I suggested in last week's discussion, the good criteria for a poor man's covered call, is more related to investors who want to use this strategy for maybe only 1 or 2 right cycles. They're not married to this particular stock and not planning on holding this leap for an extended period and selling calls month by month by month by month on the same stock. They're looking to see a position that matches the return and the structure they want, and most likely they're going to close the position after that first cycle, take the profit, and see what new 3 or 4 positions would match for the next cycle. what I do with the bull put credit spreads essentially. That criteria is beneficial if you're just trading one stock at a time. But Robert's play, he's trading SPY. And he's got it close to, I think he told Ernie, sort of a 40% return in the last 8 months on diagonal spreads on SPY on what he's invested by just moving the short call up, occasionally taking the profits out of the long and moving it up to another strike as well. But in that case, if I'm planning on trading SPY, I bought a 1-year or 2-year out leap, and I'm planning on selling it for 8, 10, or 12 months, selling premium against that leap for 8, 10, or 12 months, the criteria of that delta ratio of the short compared to the long isn't as important, because what you're trying to pick is a strike price where you feel the stock or the underlying security is likely to be trading in the next cycle, or closing it, taking the profit, and opening another spread on SPY if you wanted to continue that as well. I mentioned that because Edison just commented in. He said, can we take into account the previous gain from closing the first spread when opening the new spread? Edison, I feel you could do that. I don't see any problem with that in that situation, okay? Because if I'm trading SPY for continued cycle using diagonal spreads, using bull put spreads, at the end of the year, what would I want to see? Well, what was my running return on SPY to know if the strategy is working? So if I liquidated SPY and I got a 22% profit on investment, and then I open another diagonal spread or bull put credit spread with a different expirations, and that one ends up being a 10% loss, maybe I roll it at that point, Edison. You're right, I probably roll this position to try to get it to a gain. But if I just close that because I thought now I needed to switch to calendar puts because the market had turned bearish, well, I'd say so far I'm up 12%. And the portfolio will show that as you're tracking and managing the positions. But yes, if I'm continually doing SPY, and in your approach, or the approach you mentioned, Edison, instead of what Robert's doing by rolling this call and keeping this leap, or occasionally moving it up to take some of the profit off the table and lower the cost basis. But if you're liquidating cycle by cycle and then just opening something new on SPY or QQQ, you could factor the gain that you had in the last position into your new position. That would be perfectly fine because you're looking at a grand total. And on the portfolio, as I close out my positions and liquidate those positions, it will show me a running tab of all positions on SPY in what we call the, I'm sorry, folks. Now I want to go to a new one here. We'll go back here to the portfolio. So for example, as I close these positions here, if I expire them today and I go to the analysis tab, I'm sorry, I don't have any in there. Let me go back to another portfolio. November 27th. Okay, I apologize. I haven't closed any of these out. Let me just go here. All right, so you see, what you'd see is that any position that you have on the underlying would continue. So if I'm closing diagonal spreads after each cycle and then opening new ones, I'd see a total running return here of what I have for every position under that particular stock. And that's how I would track it. And yes, you could say that if you had a 22% gain on the first one and I had a 10% loss on the second one, this would reflect that you have a 12% total return. Ernie prefers, and I will say this, when I'm tracking a new position, Edison, in the portfolio, let's say I did have that successful calendar on SPY, and I closed it out on the last cycle, and I opened a new one, and I know that my first gain was 22% on the position. When I look at my new position for management, I'm actually not considering that. Because if my new position starts to move against me, I'm going to manage it to try to turn that loss into a gain. In the back of my mind, I know, yeah, I made 22% on the first trade, but I don't want to factor that into this one because if I'm down 10 or 15%, I want to see ways that I can take this 10 or 15% loss on this leveraged spread and maybe turn it into a gain of even only 5 or 6%. I don't want to take the loss if possible. Yes, I had a 22% gain on the first one, so if I take a 10%, 15% loss on this one, I'm still at a profit. Now, looking at this position, this might not be the best call to sell. I'm only getting 54 cents for it, but We matched our debit to strike difference ratio and our delta ratio. Part of Bob's other questions were, in what ways could I potentially not get a better return, but get a structure to where I'm keeping the delta ratio, but I'm not so deep in the money? Well, there's two ways. I could probably go to a closer in 90 call, maybe 3 or 4 months or 5 months closer in time, and that higher strike call might have a 90 delta or 80 delta because it's shorter term. So I could move this closer in with the structure. We could move this down to the 95 strike perhaps, hopefully a 97.5 if it's available, to get a better premium. But now you might not have that delta ratio that you were looking for. All right, so it's all trade-off there with what we want to see. These are too close, only 30 cents, 40 cents. But the trick is if I kept the same expiration for January 17th and I moved down, I'd get a better premium. If I move this up or closer in time, I'm paying a lower cost. But is that delta ratio still mixed or still met? Probably not. But again, if I'm trading something, a strategy on a particular stock, month by month I'm going to do diagonal spreads, or I'm planning on holding this leap and selling calls month by month against it for the leveraged return on SPY, maybe something bigger like Amazon, a higher price, that's why we'd use the leverage to begin with. Again, maybe you're not so concerned about that delta ratio. You're still concerned about the debit to strike difference ratio, and that's to prevent loss in early assignment. But the delta ratio might not be important because you're setting the short strike based on where you think the stock is not likely to go above while still getting a good premium. And the long option, you might be toggling closer in or a higher strike price to get a better debit if you wanted to have a debit less than $10, say, or something along those lines. Now, the risks of a debit to strike difference ratio. Let's go back to our 100 strike call at 53 cents here. And we have the structure that we want. Debit 1406, 1407, and strike difference of 15. Now let's say this actually cost $16. And I still get 53 cents, but now I have a $15.47 debit on the position. What is the risk of taking a position where the debit is greater than the difference in strikes on these spreads? There's three answers. Number one, the return is shallower, naturally, because the debit's higher. Okay, in our example. Number two, this still has a skewed profit that doesn't go to an upper break even yet. But if this was $17 or $18, we might hit that lower break even here around the 110 mark or so. So now we've posted really a neutral position rather than something that's semi-bullish to neutral. Okay? Not a big deal. The main issue, and this happens more on stocks than it does on SPY, and that is the case of early assignment. For whatever reason, we know it's not likely, but by January, Valero jumps up to 110. And you say, hey, I'm still supposed to be getting a profit of, I don't know, $340, $350, according to the profit and loss chart. But if this is a sudden jump, you sold a call, which obligates you to deliver shares of stock at that price. The obligation of the option doesn't change just because you're in a spread. Yes, you have the right to buy it at 85. You bought that right. You own that. You control that. But you still have an obligation to potentially fulfill shares of stock at the short strike price, like a covered call. We don't own the stock. The stock gaps up. The long call buyer here says, I'm out. I'm going to sell to close my call and take the profit. The market maker now has to start matching up short options to the long options that are being closed, or the computer does, so that there's not an overabundance of short calls. So you get assigned early. Now, your broker might not allow you to be short shares of stock depending on what type of account you have. You're in a restricted account. And they look and they say, oh, well, he's got an 85 call even though it's out to January. So we're going to buy shares of stock for him at 85, and we're going to deliver them at 100. He's going to get $15 back. Are you at a profit of 300? No. You missed the remaining time value that existed in this long option that still had about 11 months to go. You get the difference in strike prices, which is 15, but your debit was 15.47, so you actually have a loss of 47 cents. Okay? That's the risk of the diagonal spread with early assignment, is that if your broker does this for you automatically, you miss the remaining time value you would have had, you actually would be at a loss in this scenario of about $47 instead of the projected gain, which is based on the theoretical price of the long option short-term expiration. Okay? So those are just a few of the things I wanted to clarify for our discussion that we had with Robert and from our discussion last week on the good candidates. The good criteria is based on using this as a consistent strategy to find positions cycle by cycle that aren't the same. You're not married to a particular position. You're not planning on trading a stock for the next year with the original diagonal spread structure. If you are trading something that way with SPY, QQQ, you can kind of ease off on the criteria because the delta ratio might not be important. What's more important is your expectation of the stock, where you think it's going to be trading next, and for the next upcoming cycle, that's likely where you're going to be setting your short call strike price as long as the premium still matches your goals for the trade. Or part of a roll, for example, if it did breach above our short strike price as we discussed. Sam, okay, I'm going to go to these comments now because it was related to our discussion. Sam says, in this market, I lost money on my call credit spreads, bear call credit spreads, even in SPY. Not a good idea to sell calls in an incredible bullish market. That's true. And you can still roll the covered calls, as you mentioned. You can still do those other adjustments that we just talked about. But that's going back to the other point of why I would never enter a diagonal where the debit's greater than the difference in strikes when we've seen in this bull market, because rolling becomes tougher now. And it's going to increase my debit even more. So staying in that range where if I do get early assigned and still keep a profit, although small, not as big as the profit we'd expect that's shown based on the Black-Scholes pricing model and on the profit and loss chart, but I'd still have a profit even in the case of early assignment in that situation. Bear calls, I admit, yeah, would have been tough. I haven't touched those in several months, as you know. Okay, so that was just something related, Sam's comments there as well. Oh, perfect question. I meant to get to this too. I apologize. Let me go back one, ladies and gentlemen. I'm sorry, folks. I'm just going to rebuild the Valero so we can take a look at it. So that VLO we were looking at was a 2021 85 call, about 1510, and we were going to sell the near-term January, 35 days out, 2020, 100, at about 55 cents, okay? Excellent. Sorry about that. Okay, back to our spread. Edison's question is on the other side. And what do I mean on the other side? I did this. Valero falls to 90 in the first cycle. Okay, this expires worthless. I have a debit of 1406. And Edison says, would I consider rolling down this position in that case? Would I sell with the stock now at 90, would I sell the 95? Possibly. But I'm not going to get 406 for it, am I? I would roll down, but I still want to keep that debit to strike difference ratio. I see so many people get in trouble with this trying to manage the diagonal spreads. Let's say that this did expire, and we knock down our total cost on the long to 1406. The stock falls down to $89. And I say, okay, I need to make up this loss here because this thing's probably only priced at around 450, 460. Oh, I'm sorry, not that low. It'll probably be priced around $8, $9. So I've got a fairly large percentage loss, Edison, on this diagonal spread. I still have a debit of 14, though. The biggest problem I see is you have that weakness. It pulls back. Stock's now at 89. I've got a cost basis of 1406. And I'd sell the February. We're going to use January because let's say we got to January expiration. We're going to look 35 days out. And now I sell the 90 call, and I get 85 cents. Let's say I get a good premium of 85 cents in this case. For the next month out, roll down get a little bit of hedge. Okay, this one still ended up as a profit. Now, we're talking about if the stock's at 89, of course. But I'm setting this strike based on where I think the stock's not going to continue to go next. Okay? So here's the situation, Edison. I can make a 7% return, or 92, much better than the loss I'm probably taking right now if the stock recovers. Where's my issue? Now I've got the upper and lower break-evens, and the upper is only at 92.78. Whatever event caused this drop to 89, if the stock recovers and goes back to where it was, I'm at a loss on the position. Okay, I'm still maybe not as high of a loss, but I'm at a loss. And if it continues to move up, now I've got to pay to roll this one. Okay, it's still dangerous to do that, just like it is with a covered call. You say, well, I can roll down the covered calls as stock falls, get premium, get premium, get premium. Okay, great, but as soon as it recovers, you might have locked yourself into a larger loss than you were looking at originally. And remember the danger in this case, the main danger, and why I never use personally the term poor man's covered call to describe this strategy. Unless I'm using it because someone asked about a poor man's covered call. If you use the phrase, I'll use the phrase. I don't like to use it myself. Let's go back to our original position. I can't remember what that price was, 14 something. Go back to our original position with the 100 short call and that January 2020, about 400 days out in time, it's 1480 was the price, midpoint, okay? Now, again, reason I don't like the poor man's covered call term, if I bought Valero at 93.81, yeah, sure, we'd probably be selling the 95 or the 97.5. Let's be honest with each other. The 100's too far out. It's only 50 cents. So we'd probably be selling a different strike at both the covered call and the diagonal. But what is my main investment? It's that long option, right? It's the long call there. So let's say the stock drops 10%. We lose $9. The stock falls down to $84 per share. It's below our strike price. And let's say this drop happens soon. It happens within the next month to expiration. Okay, we'll leave the volatilities where they are. Yeah, this 55 cents expires worthless in our favor. This option dropped from, theoretically, with a volatility of 0.31, would drop from 1480 down to 1048. Okay, we lost 432 on a stock that fell $9. That's not too bad. But what is that percentage-wise, right? What is $4.40 of $14? It's about 26% loss, isn't it? So with about a 10% loss, you'll be in a 25 to 30% range of loss on the long haul. And if it drops 15%, if this goes down to 80, right, about 14, 15 points from 94, we lose that roughly 14, 15%. Not quite cut in half, but we're pretty close to a 47, 50% loss on the initial position. And it's probably about 42, 43. This is why I don't like the term poor man's covered call. Because if I do a covered call, I buy the stock, I get 3% in premium for my position, the stock falls 10%, I'm only down 7% on my investment. On the diagonal, it's leveraged both ways. So this 10% decline, where I'd be at a minus 7% loss with a 3% premium in, this is still going to be a 20, 25% loss, including the premium we keep. Yes, it was a higher premium, but it's still going to decline. Okay? We keep that no matter what happens. In this case, it expires worthless, but 10% drop, 25, 30% loss. We keep 5 or 10%. We're at 20 to 25% loss on the investment. And if we see a 15% loss on the underlying stock, so this is the underlying here, 15% loss, 10% loss, we're going to be close to a 35 to 45% loss on the leverage position. It works both ways, all right? And that's the problem. Okay, so I just wanted to re-mention that, Edison. In addition to rolling down, this is the risk you face. So why I was showing you that, why I wanted to reemphasize that example. I looked at some of the other questions that came in, and I sort of lost my train of thought. Why I mentioned that is said, would you ever roll down the short call as this is declining? And the answer is yes, you could do that, but I still want to keep that debit to strike difference ratio, if possible, because if it recovers, I'm going to be at a bigger loss. But why I wanted to show you that illustration is that if this stock falls and it drops to 90, 87, 85, and I'm rolling this down, I'm getting another 40 cents, 50 cents. What did we see? I'm losing $3, $4, $6, $7 on this option to gain another 40 cents at a lower strike. It's better to try to get out of this position and do the reverse instead of trying to roll down the call consistently and then saying, oh, I hope it comes back up. But if you keep rolling down, once this goes below this price, by the way, now you're just losing time value. You've got no intrinsic to deal with. You've got no intrinsic value to help you. The stock's down at 81, 82, or 83. And then eventually, if you keep rolling down, you're going to be in a bearish position. But if it recovers, now your loss is up here. So what I'm illustrating is, if you see the market start to turn, if you see it start to fall, is it okay on the diagonal spread to say, oh, I'll just roll down the call like I would in a long-term covered call holding? Or is it better when you see that to get out of the position because you're not going to be able to make back what you're losing on the long option by just rolling down the short term, and you're just increasing the losses on the position? Hedge it with a put, maybe turn it into a strangle long term or something along those lines to help in a short-term pullback or a correction, which might, who knows, might be coming. But it's dangerous to just keep rolling down because percentage-wise you're getting killed on this long option. We don't want to see double-digit losses, but that's what happens to the lie of leverage. And if you take what we talked about, a 25% loss on a position of what you paid initially to get in, if you hit a 25% loss, do you need a 25% gain to get back to break even? No, you need a 33% gain on what you have remaining in the position. Just like if you took a 33% loss, if you had $1,000 invested in this position, the stock fell, and now your option's only worth $670, you need to see a gain of 50% of this, what you have left, $330, to get back to break even. Okay, so if you had just $1,000 in the position, you lose $330. Now you've got to see this investment, that leap option, gain 50% of what you have left in it to get back to break even. That's the lie of leverage, the slippery slope of gambler's ruin. This is one of the main reasons we trade a lot of our portfolio with the radioactive trading techniques as well. Excuse me, folks, I need a drink of water. One last topic here on the diagonals before I move on to Doug, who's been extraordinarily patient, needs some help with his evaluating the portfolio for his position. Mark says that I've never used the delta ratio between legs on diagonal calendars. What's the trouble one avoids using the ratio? Is it the potential loss on a move upward? Potentially, yes. On the underlying well beyond the strike price of the short. That's the idea, Mark. Okay, that is sort of the idea in that question. And what I mean by that is that typically when I see delta ratios that are in that lower range, what that typically means is you're closer to more of a horizontal spread. Your strikes are getting closer together in that scenario, which might put you in that position to have that upper and lower break even. Now, that should be avoided by using that net debit to be less than the difference in the strike price. But you see here, this one's a net debit of 741 with a 7.5 strike difference, and I allowed it to go to a delta ratio of 1.4. This is still probably going to be a good profit and loss chart, but it's steep and then it skews off. Okay, as you put that delta ratio closer and closer together, get closer to 1, you're talking about horizontal spreads now. Delta ratio of, delta ratio of less than 0. As they get closer together, Now you're talking more of a horizontal, which is a different structure. The idea behind the delta ratio of 1.8 or higher, looking for a longer term option, is to give you upside benefit on a neutral to bullish position. But at the same time, what are we saying? I'm saying that if my long option delta is 0.8, you know, some investors actually say you want a delta ratio of 2 or greater. So the delta ratio the delta of the short, can't be greater than 0.4. So that's giving you that sort of wider skew. If I got closer, and let's say I used a delta of 0.7, well, you know what happens now. You're not as deep in the money. You're probably paying a lower debit mark, which is great. But if I use the 0.4 or the 0.45, this means this is pretty close to at the money, so I'm looking at something that's a little steeper. Okay? Might have a higher max profit because of the lower debit, but it's a little bit steeper to the upside. This again comes down to that other main topic, Mark. There's nothing relatively wrong in either case of using a delta ratio of less than 1.8, depending on your trading plan, your approach for the diagonal spreads, and what your risk tolerance is. I just go back to the calendar call home. This little static drawing that we have here is something related that we'd expect with a delta ratio of probably 1.7, 1.8 or greater. A delta ratio of 2 means that when the stock starts to move up, in theory, I'm gaining twice as much on this long as I'm losing on this short as we start to move up here. So I could liquidate earlier for a higher profit with a higher delta ratio. But we do, regardless of what our delta ratio was at the beginning, we do hit that problem where at expiration of the short option, our delta goes automatically to 1 or to 0, depending on if it's in or out of the money. Okay? And then as you start to get closer to a delta ratio of 1, what are we talking about there? We're talking about horizontals, okay, which is more like a butterfly trade. You've got the same strike. I've sold the 95 call on Valero and bought the 95 several months out. They're almost similar delta. They're only changed by the time value. Same strike or horizontal spread. They have an upper and lower break even, and this is not necessarily neutral to bullish or neutral to bearish. It's just straight out neutral. Not expecting the stock to move. Would have had a hard time with that position, as Sam mentioned, in the last few months as well. Okay, and this also, I'm sorry, Mark, this also goes back to that discussion that we were talking about a little bit with Robert. And he comments that this begs the question whether you're in the diagonal spread or poor man's covered call for the short term, taking the profit cycle by cycle and moving into new positions, or whether you have that longer term outlook for the position that you're planning on holding that leap option and selling month by month by month against that position long term. Okay, that would be as well. All right, and yeah, and Robert's talking about it depends also how far out in time you would go. Okay, let's see here. Sam adds his comment about the, it's not a good idea to buy leaps calls because if the market drops for a week or two every day, then you're coming to lose on the position. Yeah, you start to see that quick decline that we talked about, and then you need to adjust that further on as well. And something related to what we do with the bull put credit spreads, I'm not going to get into it now, but Edison follows up, would you suggest a pendulum adjustment, which I do on the bull put credit spreads, on the diagonal spread? And the answer is no. I wouldn't do that because I did my analysis, Edison, on a long option going far out in time that I'm bullish on the stock long term and selling against it. On a bull put credit spread, one of the adjustments I like to use is if the stock falls between the two strike prices suddenly and I'm losing or close to break even on the bull put credit, I might be able to do a pendulum adjustment by selling to close my long put, buying to open a higher strike put, and with one swing converting my bull put to a bear put debit, which will continue to profit or keep a profit if the stock falls. A lot of times that works. I wouldn't do it in this case with the far out option or the near term option, but I wouldn't do it in this case with the far out option and go in this route, because if my sentiment is changed on the stock, I just want to get out of this to lower the losses. Or what do we know about a bearish condition, Edison? Normally, a bearish condition is just shorter term, maybe 1 month, maybe 5 weeks, maybe 2 weeks. And then you get a longer bull run, then you get a short drop. And then a longer bull run, and then a short drop. So if I was out to January 2021 and a correction hits in January, and I want to convert this to a bear, I'm likely only converting it to a bearish position for a few weeks. And then as the market recovers, now I've got to swing back and do a bullish position. I might be more tempted to get out of this as a diagonal call spread, Edison. And if I still wanted to track this stock, maybe do a calendar put and put that as a bearish position. Many times rolling down doesn't help. That's what Sam says in this case. Rolling down or making too many adjustments doesn't help. And the main key here is, remember, I paid about $14 for this one. As the stock swings, this might only be $5 or $6 for the out of the money call that's still out to January 2021. But what have I done? I've increased my cost to 19. Now it's even harder to make a profit. It doesn't work the same way in a diagonal spread as it does with a vertical. And now, as Sam mentions, what ends up happening is that the cost and the potential for loss now is much bigger than the potential gains you could make by using it in that case. Okay, so I wouldn't do the pendulum adjustment on a diagonal spread. I would just do that on verticals only. Bull put credits, bull call debits, and more.